All right, today on The Explainer, we are diving into a huge policy shift happening in China. We're breaking down a really fascinating JP Morgan report that tries to make sense of it all. And, it all kicks off with a bit of a mystery. So, let's set the scene. The time is July 2025. And seemingly out of the blue, the Chinese stock market just ignites. A massive rally starts, but nobody can quite figure out why. So you can imagine everyone, every analyst, every investor was asking the exact same question. What on earth just happened? What was the trigger? And why were only certain stocks going through the roof? And get this, the scale of this thing was pretty wild. In just about 3 weeks, lithium stocks shot up 22%. Solar and cement weren't far behind, both jumping 16%. This wasn't some case of a rising tide lifting all boats. No, this was targeted. The gains were so concentrated, it had to be something very, very specific. And that's exactly what it was. The trigger, according to the JP Morgan report, was a new government directive. They're calling it the anti-involution policy. So, what in the world does involution even mean?
Well, the policy is meant to fight this very idea of involution. The best way to think about it is like a death spiral. It's when companies in the same industry compete so hard, so brutally on price, that eventually nobody makes any money. The report uses terms like price dumping and malicious competition. Basically, it's a race to the bottom, and the entire industry suffers.
So how do you fix a problem like that? Well, the government is using a classic carrots and sticks approach. The sticks are the restrictions. Things like forcing steelmakers to cut their output or telling solar companies, hey, you cannot sell your products below this price. Then you've got the carrots, the incentives. We're talking huge new infrastructure projects to boost demand and a big push for higher quality products. It's a 1-2 punch designed to make these industries healthy again. Now, when you have a policy this specific, you're going to create some very clear winners and, well, some losers. So let's dig into who this policy was really designed to help. And let's be clear, this wasn't random. The government didn't just throw a dart at a board here. The report shows they were surgically targeting industries that were in deep, deep trouble. We're talking sectors with obvious financial distress, terrible profitability, and cash flow that's going in the wrong direction. And I mean, just look at these numbers. The data tells the whole story. Over the last year, the lithium sector was bleeding cash with a negative 31% net margin. Solar was also in the red at negative 6%. Now, compare that to a sector like coal sitting at a healthy 14%. Suddenly, it's crystal clear why the government stepped in exactly where it did. In this right here, this is the aha moment. This is what solves our mystery from the beginning. The biggest stock market jumps weren't in the successful companies, they were in the industries that were losing the most money. The market wasn't reacting to good news, it was reacting to a government lifeline, a rescue.
So does this mean the opportunity's over? Well, JP Morgan's analysis suggests maybe not. Even after that initial pop, key sectors like lithium and solar are still trading at these huge discounts compared to their 10-year history. The report implies that even after the rally, they could still be undervalued. There might still be room to run.
If you're sitting there thinking, wait a minute, this kind of heavy-handed government intervention, it sounds kind of familiar. Well, you'd be right. This isn't the first time we've seen this movie. China has a playbook for this, and they ran a very similar one about a decade ago. Let's rewind to late 2015. China rolled out what it called supply-side structural reform. It started with an announcement, then a massive subsidy fund, and then, bam, just a few months later, they dropped these strict production limits, like the famous rule that only allowed coal mines to operate 276 days a year. So what do you think happened to the price of coal after that? It exploded. We're talking an 85% jump. The government forced supply down, and prices went way, way up. But hold on. Get this. An 85% price jump is huge, yeah? But the impact on the industry's profits? It was absolutely massive. Earnings skyrocketed by 240%. That is why investors are paying such close attention to this new anti-involution policy.
It shows that when you restore rational pricing, it can have this incredible leveraged effect on the bottom line. So let's bring it all home. What's the key takeaway from all this analysis? The JP Morgan report really boils it all down to one single central thesis about the road ahead. Their conclusion is that this is not some quick flash-in-the-pan trade. They call it an 18-month trade. The thinking is that the real goal here is a huge, coordinated effort from government to banks to the businesses themselves to get pricing and profitability back to normal, sustainable levels. So when you hear a term like 18-month trade, what does that actually mean for you? Well, it means this is a medium-term play. It's a signal to be patient. The idea is that the real effects are going to unfold over the next year and a half as all the detailed rules kick in. And the end goal isn't just a short-term stock pop, it's about fundamentally repairing these industries for the long haul. And that all leaves us with one last crucial question to think about. This whole anti-involution policy, it feels like a really significant shift, a pivot away from just growth at all costs towards a new focus on sustainable, healthy profitability. So what could this strategic change mean for the long-term future of China's economy and its role on the world stage? That's the story we should all be watching.